Imagine running a store, factory, or restaurant where every sale, every expense, every decision was remembered only by your brain. No written bills, no ledgers, no reports. Just chaos. That's where accounting steps in with a clear purpose. It exists to record, report, and reveal the story of business in numbers. In this video, we'll explore the 4 major objectives of accounting and why they are absolutely essential for any modern enterprise. Think of accounting as a powerful information system. It captures financial transactions and turns them into financial statements like the profit and loss account and balance sheet. These statements are then shared with different user groups, some internal like managers and some external like investors or banks. All of this serves one purpose: to provide useful, reliable information. Let's now break down the 4 main objectives. The first and most basic goal of accounting is to maintain a systematic record of all business transactions. Why is this important? Because even the smartest CEO can't remember every transaction over weeks or months. Accounting provides a written, verifiable trail of all activities, whether it's buying goods, paying wages, or receiving income. This not only helps in future reference, but also serves as evidence in audits or disputes. At the end of the day, every business wants to know one thing: are we making money or losing it? That's where the second objective comes in, to calculate profit or loss. By comparing total income and total expenses during a period, accounting helps us arrive at the net result. For example, if revenue is Rs 6 lakh and expenses are Rs 5.4 lakh, the business earns a profit of Rs 60,000. Without this clarity, planning for the future would be a shot in the dark. Knowing profit is important, but knowing the financial position is equally crucial. The third objective of accounting is to show the organization's assets and liabilities at a given time, typically at the end of the financial year. This is done through the balance sheet. It tells us what the business owns, what it owes, and how much equity the owner holds. It's like a financial snapshot that helps managers and investors judge the health of the business. The fourth and final objective is about communication, providing financial information to those who need it. Internal users like managers rely on accounting for planning, budgeting, and decision-making. External users like investors, banks, suppliers, or regulators use the same data for entirely different reasons. Let's look at some of these users and why accounting information matters to them. Investors want to know the potential risk and return on their investment. Employees and unions care about the company's stability and distribution of profits. Banks and lenders assess whether the business is creditworthy and can repay loans. Suppliers and creditors want assurance that they will be paid on time. Customers care about continuity. Will the company still be around to provide goods and services? Governments use the data for tax collection and compliance checks. Social groups and environmental agencies track ethical and sustainability efforts. Competitors use published reports for benchmarking and strategy. Accounting is not just a financial diary, it's more like a dashboard of a car. The speedometer shows performance, profit or loss, the fuel gauge shows remaining capacity, cash flow, and warning lights show risks, debts, liabilities. Without it, you'd be driving blind. Let's summarize the 4 key objectives of accounting. Maintain accurate records of all financial transactions. Calculate profit or loss for a specific time period. Show financial position through the balance sheet. Provide useful information to internal and external users. In the next lesson, we'll dive into the role of accounting and how it has evolved from a simple recording tool to a powerful strategic resource.